Hello, ladies and gentlemen. Welcome back to our channel. A whirlwind of events has unfolded on the global stage, and today we're diving deep into the latest developments concerning international trade, economic policy, and the intricate dance between major world powers. We have some significant news regarding the ongoing tariff situation, Federal Reserve maneuvers, and the broader economic landscape that could impact everyone. There are several breaking points and rumors circulating, particularly from this morning, that demand our attention. We'll unpack the European Union's surprising offer to the United States, delve into the Federal Reserve's closed-door activities, and analyze President Trump's recent commentary, which seems to tie everything together. Stay tuned as we explore these multifaceted issues, and we promise to provide a comprehensive conclusion at the end of this analysis. Before we proceed, if you find our content insightful and wish to stay updated on economic and political news, please consider subscribing to our channel and hitting the like button. Your support is incredibly vital for helping us grow and continue bringing you these updates. The world of international trade is rarely static, and recent developments underscore this volatility. The European Union has extended an offer to the United States proposing the abolition of reciprocal tariffs on industrial goods. This is a fascinating turn of events. Concurrently, reports indicate the European Union is prepared to discuss zero-for-zero tariffs with the U.S. This development is particularly noteworthy because only yesterday, the prevailing sentiment, fueled by long-standing rumors, was that the EU would immediately retaliate against any new U.S. tariffs, possibly mirroring Canada's previous actions. The expectation was a tit-for-tat escalation, potentially involving tariffs around 25% or similar figures on European goods entering the U.S. market. However, within roughly 12 hours of those tariffs potentially being announced or solidified, the EU seemingly pivoted, signaling a readiness to negotiate towards eliminating these trade barriers altogether. This rapid shift suggests a complex interplay of economic pressures and strategic calculations are at play behind the scenes in Brussels and Washington. Please take a moment to let us know in the comments where you're watching from. We love hearing from our global audience. And remember to watch this video through to the end, as we'll be summarizing the key takeaways and offering our final conclusions on these complex events. Now, adding another layer to this economic puzzle is the activity surrounding the Federal Reserve. Reports surfaced this morning indicating the Fed is scheduled to hold a closed-door board meeting today. While the specifics remain confidential, such meetings often precede significant policy announcements. Whispers and speculation about a potential emergency interest rate cut have intensified. Whether such a cut materializes remains uncertain, but we'll examine the current odds according to market indicators later in this video. The context for this potential move is crucial. President Donald Trump has been actively using his platform, putting out tweets that strongly emphasize the necessity of interest rate cuts. He argues that lower rates are vital for economic stimulation and maintaining competitiveness. We believe this pressure from the White House is a significant factor driving the current discussions, and perhaps even the timing of the Fed's meeting. Trump's focus on interest rates appears central to his broader economic strategy, potentially influencing everything from tariff negotiations to domestic policy priorities. It seems plausible that the push for lower interest rates is a primary driver behind the recent flurry of tariff-related activities and negotiations. President Trump appears to be leveraging trade policy as a tool to influence monetary policy, creating economic conditions that might compel the Federal Reserve to act on rates. This strategy intertwines global trade disputes with domestic economic goals. Alongside this, there's the well-established objective, particularly concerning China, of revitalizing significant manufacturing capabilities within the United States. The aim is to reduce reliance on overseas production and bring jobs back home, shifting away from a model where extensive outsourcing is the norm. This dual focus, pressuring the Fed on rates while simultaneously pursuing a return to domestic manufacturing, shapes the administration's approach to international economic relations. The tariff announcements and the subsequent reactions from countries like the EU fit within this larger strategic framework, where trade actions serve multiple interconnected purposes aimed at reshaping both the domestic and global economic playing field. The European Union's statement about being ready to discuss zero-for-zero tariffs with the United States presents an interesting dynamic. This shift occurred rapidly after initial expectations of immediate retaliatory tariffs from the EU, similar to what Canada implemented previously. Within just 12 hours of potential U.S. tariff announcements, the EU signaled openness to negotiation aimed at complete tariff removal on industrial goods. This swift change highlights the intense pressures and strategic considerations influencing decisions in both Washington and Brussels. It's not just the EU. Other nations are also indicating a willingness to engage in similar discussions. Countries like Vietnam, Israel, and India are reportedly open to negotiating tariff reductions with the U.S. China, too, would logically want to negotiate, given the significant impact U.S. tariffs have on its economy. However, President Trump's stance towards China remains particularly firm, and it's questionable whether he would allow substantial tariff reductions, although some speculate a deal involving TikTok could be a potential exception. Regardless, significant tariffs on Chinese goods are likely to remain a fixture of U.S. policy under the current administration. The situation with the European Union is distinct from that with China. While the EU does maintain a trade surplus with the United States, which was the initial justification for Trump imposing tariffs, it's not nearly as substantial or structurally embedded as the deficit with China. Furthermore, the EU employs different mechanisms that affect trade, primarily through value-added taxes, VAT. Unlike direct tariffs, VAT is typically levied on imported goods when they are purchased by a European company within the EU. While not identical to a tariff, VAT acts similarly by increasing the cost of foreign goods, thereby impacting trade flows. European companies pay this tax on U.S. goods they import, making them less competitive compared to domestic alternatives. Additionally, the EU is known for extensive regulations across various sectors, which can also create barriers for U.S. products, particularly agricultural goods, making it challenging for American farmers to compete effectively in European markets due to differing standards and compliance costs. Therefore, any comprehensive trade negotiation between the U.S. and EU would need to address not just direct tariffs, but also these VAT applications and regulatory discrepancies to achieve truly level playing field. The prospect of zero-for-zero tariffs is thus more complex than it initially appears. While the EU might seem eager to return to a zero-tariff environment, potentially viewing it as advantageous given their existing VAT system and regulatory landscape, the negotiation would involve intricate details beyond simple tariff rates. The U.S. side would likely push for concessions on VAT treatment for American goods and adjustments to regulations that currently disadvantage U.S. exporters, especially in agriculture. For the EU, agreeing to zero tariffs might be strategically appealing if they believe their other trade tools provide sufficient protection or competitive advantage. The rapid pivot from threatening retaliation to offering negotiation suggests they might perceive an opportunity within the current dynamics, possibly calculating that the overall benefits of tariff removal outweigh the costs, especially if they can maintain their VAT and regulatory structures largely intact. This intricate negotiation landscape involves balancing direct trade barriers with indirect ones, reflecting the different strategic approaches the U.S. and EU employ in managing international commerce. Amidst these international trade maneuvers, the underlying focus, particularly from President Trump's perspective, appears to remain squarely on domestic economic conditions and influencing the Federal Reserve's monetary policy. The strategy seems to involve using external pressure, like tariffs, to shape the internal economic narrative and create conditions favorable for interest rate cuts. The emphasis is on stimulating the U.S. economy through lower borrowing costs. This links directly to the observed data and market sentiment regarding inflation and potential Fed actions. Recently, alternative inflation measures like trueflation have indicated a significant slowdown, with figures reportedly hitting a 4.5-year low at around 1.1%. While official figures might differ, the trend suggests inflationary pressures might be easing. We are keenly awaiting the official inflation data release scheduled for April 10th, which will provide a clearer picture. Trump frequently highlights metrics like falling oil prices and food prices as evidence that inflation is under control, bolstering his case for the Fed to cut rates without delay. He frames the Fed's current stance as slow-moving and argues that the U.S. economy is being unnecessarily hampered by high interest rates, especially considering the billions of dollars he claims are flowing into the U.S. due to existing tariffs. Therefore, the tariff situation, the EU's offer, and the broader global trade discussions can be viewed through the lens of this overarching objective: securing interest rate cuts from the Federal Reserve. The actions taken on the trade front serve as both leverage and justification for this domestic economic goal. The closed-door Fed meeting today adds another layer of intrigue, fueling speculation about whether an emergency rate cut is imminent or if it's simply part of ongoing deliberations. Prediction markets like Polymarket reflect this uncertainty, but show growing anticipation of rate cuts later in the year. For instance, while the May 7th meeting is largely expected to see no change, around 72% probability, the odds for a decrease rise significantly by the June meeting, with a notable chance of a 25 basis point decrease. By July, the probability of a cut increases further. Forecasts for 2025 suggest multiple rate cuts, possibly 3 or 4, are anticipated by the market. This reflects a belief, perhaps influenced by Trump's pressure and the potential economic headwinds, that the Fed will eventually move towards easing monetary policy. The strategy appears to be an aggressive push to compel the Fed to lower interest rates very early in a potential second Trump term. The logic is that lower rates, combined with controlled inflation, will create a more favorable economic environment. Inflation, according to some metrics and Trump's own statements, is indeed down. The Truflation measure, for example, was recently reported at 1.1%, a 4.5-year low. Official numbers are pending, but if they confirm a low inflation trend, the argument for rate cuts strengthens. Trump directly links low oil and food prices to his claim of no inflation, positioning the Fed's caution as detrimental. The closed-door Fed meeting adds to the suspense, though an immediate emergency cut seems unlikely based on current market odds, which still heavily favor no change in the upcoming May meeting. However, the probabilities shift towards cuts in the June and July meetings, and projections for 2025 anticipate several cuts throughout the year. This aggressive maneuvering uses tariffs and economic data points to build pressure on the Fed, aiming to align monetary policy with the administration's growth objectives as quickly as possible. Another significant element in this complex equation was the rumor circulating about President Trump potentially pausing tariffs on all countries except China for a 90-day period. This rumor, however, was reportedly refuted by the White House, which labeled it as false or fake news. Predicting Trump's actions, especially regarding tariffs, is notoriously difficult. Even he might not have a fixed plan at any given moment. If such a pause were true, it could be interpreted in several ways. One interpretation is that Trump might have underestimated the negative impact the widespread tariffs were having on the stock market and sought a temporary reprieve to allow markets to recover and reassess the situation. It would effectively be an admission, albeit indirect, that the economic consequences were perhaps harsher or more immediate than anticipated. Pausing tariffs, excluding those on China, maintaining that specific pressure point, would allow for a period of negotiation and potentially lessen immediate market volatility, giving the administration space to recalibrate its strategy based on economic feedback and ongoing trade talks. However, since the White House has denied this rumor, the current strategy seems to remain focused on maintaining pressure through existing and potential future tariffs. The commitment level to these tariffs is a key question. Are they primarily a negotiation tool, a mechanism to force concessions on trade practices, regulations, VAT, and ultimately, to influence the Fed's interest rate decisions? Or are they a long-term fixture intended to fundamentally reshape global supply chains and force domestic production back to the U.S., regardless of short-term economic costs or market reactions? Trump's rhetoric often emphasizes bringing production back, suggesting a deep commitment to that goal. He highlights the trade deficits as unsustainable and harmful to the U.S. Yet, the effectiveness and cost of achieving this through broad tariffs remain debatable. The intricate balance involves weighing the goal of domestic manufacturing against the potential for price increases for consumers and businesses, disruptions to existing supply chains, and retaliatory actions from other countries. The EU's quick offer to negotiate zero-for-zero tariffs might indicate that some countries prefer negotiation over protracted tariff battles, potentially offering Trump quicker wins on the trade front, even if the underlying issues like VAT and regulations require more complex solutions. The economic outlook remains clouded by these interconnected factors. The possibility of a U.S. recession in 2025 is still being debated, with prediction markets placing the odds around 57%, though this figure fluctuates considerably based on daily news and market sentiment. Just last week, those odds were significantly lower, highlighting the volatility and sensitivity to new information, like tariff announcements or Fed signals. A key indicator will be the upcoming Q1 GDP growth figures. If Q1 shows positive growth, it might stave off immediate recession fears, even if Q2 were to dip into negative territory, as a technical recession typically requires 2 consecutive quarters of negative growth. However, if Q1 itself is negative, recession concerns will mount significantly. This economic uncertainty is precisely what Trump seems to be leveraging. He wants to force the Fed's hand on interest rates, believing that lower rates are the key to preventing a downturn and ensuring strong growth. The tariffs, therefore, become a multi-purpose tool, pressuring trade partners, justifying rate cuts by pointing to controlled inflation, partially resulting from the tariffs' dampening effect on global trade, and promoting the long-term goal of domestic production. In conclusion, the current global economic landscape is marked by significant strategic maneuvering. The European Union's offer for zero-for-zero tariffs represents a major shift, moving away from expected retaliation towards negotiation, though the complexities involving VAT and regulations remain substantial hurdles. The Federal Reserve is under considerable pressure, evidenced by closed-door meetings and President Trump's relentless calls for interest rate cuts, which he appears to see as the primary solution for economic stimulus. Trump seems to be employing tariffs as a multifaceted strategy, partly to address trade imbalances and encourage domestic manufacturing, but perhaps more significantly, to create economic conditions that necessitate lower interest rates. Inflation metrics are currently favorable for rate cuts, but the true impact of tariffs on consumer prices and the broader economy is still unfolding. The uncertainty surrounding potential tariff pauses, ongoing negotiations with various countries, especially China, and the looming possibility of a recession create a volatile environment. The ultimate trajectory will depend on how these intricate negotiations evolve. The Federal Reserve's response to sustained pressure and incoming economic data like Q1 GDP, and whether Trump prioritizes the long-term structural goal of domestic production over the short-term economic stability potentially offered by easing tariff pressures and securing quicker interest rate cuts. It's a high-stakes game with global implications. Thank you for watching. Please subscribe, like, and comment below.